So, Chris, we've talked ad nauseum about loan officers. They need to jump into non-QM because it's a huge growing component of the market. We had like a 6 months or whatever it was a couple of years ago where it was kind of unsteady, and we had a number of companies that kind of fell apart. But since then, the trajectory has gone up and up. I think we had a 4% increase in 2021. 2022, we saw a $100 billion increase in the amount of non-QM funded. That number continues to escalate at a compounding rate. So we see the market going in the right direction. What's the future hold for Oaktree right now, and how do you see the next year or 2 years with non-QM?
Oaktree, we had some of our most challenging volume months at the beginning of 2023, where we really saw volume and inflows drop kind of precipitously as a result of 2022 rising rate environment and everything else. We've really seen loan officers become re-engaged in the product. They understand it more. They're seeing more, of our competition out there. They're being used to it, right? Oaktree is, we're one of the originators in the space.
Yep.
We're one of the only ones that still has the same name that still does non-QM loans. There's Citadel that's now, obviously, as you know, Acra, and then us. And we've been in business since 1989. We've changed owners over the past few years, but we've been here for a long time, and we were one of the very first pioneers of non-QM as it is today. Because of that, we're positioned. We're growing. We have had consecutive 3 months in a row of upwards volume growth. We plan to do that again this month, and then into the next year, we see ourselves growing exponentially. We've hired some new staff. So if you're a new client or an existing client and you haven't done a loan with us in a while, you might talk to a fresh face. But we've put them through a very engaging training program. They're experts in non-QM. They know how to get deals done. They've got the staff in place to help you get your loan closed and funded timely and efficiently. And the other thing too, why you're going to continue to see growth in the non-QM sector is that we're actually specifically targeting and going after agency volume, not primary residence. We're not talking 95% loan to value. We're talking about the investment properties, talking about second homes. The agencies have priced themselves out of that. They don't want to do those loans, period, in the discussion. So we have ways of securitizing those loans and doing loans with investors that like the space, that like the risk, that like the appetite, that don't have the terrible GSE overlays, and we get really great pricing from those folks. So on top of that, we've bridged out. We offer through our sister company. We're doing RTL financing, short-term fix and flip loans that you guys have been interested to. And we have a lot of opportunities for growth. So we are very excited about what 2024 has to offer. In 2025, we think that the rates are going to moderate, probably toward the end of the year, beginning of next year, and we will see the Fed starting to lower rates. This week has been a treasure trove of data for anybody who's hoping for lower interest rates. Post the last little spike that we had as far as inflation goes, and I say spike. Anything, if you look at any trajectory of anything, anytime you want to see progress being made, it's always going to flatten out before, it's always going to have some type of a stall period. The Fed said it themselves in their minutes that they weren't planning on lowering interest rates anytime soon. They could have 3 interest rate reductions this year, but that doesn't mean they're all going to happen now. Right. I think the media is just so hyper-focused on when's the rates going to go down. It's like, it doesn't matter. The rates are going to go down whenever they go down. But in the meantime, longer for better isn't bad for mortgage banking. It's not bad for your EPOs. It's not bad for any of that stuff. We want to see rates kind of go like this. We don't want to see rates go like that because that's expensive for everyone, mortgage bankers included. Mortgage bankers, mortgage brokers, when rates go like this, that means everything you just did here, you're going to have to go write a check for. And that's no fun for anybody, right? So we don't want to have to write checks back. You guys don't want to have to write checks back. That's not what we're in this for. We'd like to see a nice steady decline in rates, and that will get more homeowners available, more homeowners access to more available credit, and we're excited to see what the future holds, and that will help us continue to grow our volume and you guys as well.
You know what? I'll tell you, I was thinking about this. It's why I think that we don't have a ton of adoption from loan officers in the non-QM space. This just occurred to me. There's a whole segment of this market of loan officers who don't know what it's like to write anything but a Fannie Freddie Ginnie loan. They've never done it. It's been over a decade. It's dating myself. It's dating you.
Yeah.
But I'll bet you there's 40-50% of the industry who's never seen a loan that's not a Fannie Freddie Ginnie, and so it's the great unknown.
Go back to when we first started doing interviews. You said, why non-QM? And I would tell you that if loan officers were in the business for 10 years, you could call that a career.
Yeah.
Right? Time, when we first started talking, 10 years was 2007. You go back to 2007 and you've never wrote anything but agency loans. There was not anything else out there. And even the jumbos adapted that they do AUS jumbo loans. And, there's been a couple of failed attempts by different non-QM investors who tried to come out and say, oh, we'll do DU and then, just underwrite it to, whatever their guidelines are. But it's like, it's ill-adopted because you're still fully underwriting the loan. You can't just actually rely on those findings. So there's never been a really good transition period from that subprime to agency and then the agency over to non-QM because it's a different underwrite. It's a different vehicle. We actually look at stuff now. So you actually have to take your time to underwrite loans. Back in the day, we'd pool, a bunch of loans together and they do a sample. They'd underwrite 10% of them. Okay, here you go. Here's your 10%. This is what we found. Looks good. We're going to buy the whole lot. Every single loan is diligent. Every reviewed, and believe me, you can ask my staff. They spend a lot of time. Hey, why did you make this road? Why did you do that loan? Why did you? We have to answer those questions. But we try to not let that affect the front end. We're providing excellent service to our customers and not overstepping out loans. So, that's the ever growing challenge. But that's the nature of the beast. So we're excited that the next couple of years are going to be great volume months for non-QM. It's going to grow. I mean, we used to do. Subprime used to do half the volume that agents do.
Totally.
So it's, we don't know that it'll be quite back to those numbers, but if it can be, 10 to 15%, 20%, I think we'd be all very, very excited.
Well, yeah, but I mean, that is kind of a trip though, because you were just doing your Fannie Freddie Ginnie. Like I'm thinking, we have manual underwrites. Well, what does that actually mean? Well, here's what it means. It means your non-QM guys are actually going to have a human being sit down there and look at a file, and they can make exceptions on those files. So if something makes sense, they don't have to listen to a machine.
The hilarious part is that, for years it was like, can we make an exception on that? Look at me like I had a nose growing over here out of my face. Like, what do you mean make an exception? We can't do that. It's an agency loan. It says yes or no. I said, yeah, but the guy's been on his job for so long. He's got all this income. Well, can't we make an exception? He's like, we can't do that. It's an agency loan. I'm like, that seems ridiculous. So the resurgence of non-QM has been a blessing, I think, for the industry. I think it's been a blessing for homeowners. And
totally.
Super excited about what that has to bring to the future, because there's more and more stuff to come as technology improves. The bank statement things get better. Everything gets better along the way, and we're very excited to see where it leads. So,
well, Chris, I totally appreciate you jumping on board. And for those who are watching right now who never really kind of experienced loans outside of your typical conforming, FHA, VA stuff, you never really kind of dipped into the non-QM, the all doc type of loans that we're talking about. These guys will train you. They'll literally train you on the products, how to be fluent in the language, to speak with confidence about what the hell is going on, and actually point you in the right direction to go find the agents and build the team so you can go ahead and grow your non-QM business. To not do this is frankly being less than a professional in this one person's opinion. So reach out to these guys. They'll train you today. Chris, thanks so much for your time, man. I appreciate it.
Thank you, Brian. I appreciate you.